Hello, welcome to Morris Money, where we give you stock tips in under 5 minutes. I'm your host, Morris Willie. Today, we're talking about the fair value of Levi Strauss and Company, or better known as Levi. Now, this is going to be similar to something we did a couple videos ago, where we're going off of Simply Wall Street's discounted cash flow model for this, so stay tuned and see how much Levi Strauss could be worth. Now, companies can be valued in a lot of ways, so the discounted cash flow model strategy is only one of those ways, but that's what we're going to be using, as I've said before. Now, Simply Wall Street uses a two-stage growth model, which simply means that they're going to take into account two stages of company growth. In the initial period, the company may have a higher growth rate, and the second stage is usually assumed to have a stable growth rate. To start off with, we need to estimate the next 10 years of cash flows. Where possible, we can use analyst estimates, but when these aren't available, we'll extrapolate the previous free cash flow from the last estimate or reported value. We assume companies with shrinking cash flow will slow their rate of shrinkage, and that companies with growing free cash flow will see their growth rate slow over this period. We do this to reflect that growth trends to slow more in the early years than it does in later years. Generally, we assume that a dollar today is going to be more valuable than a dollar in the future, so we discount the value of these future cash flows to their estimated value in today's dollars. The second stage is also known as terminal value. This is the business's cash flow after the first stage. For a number of reasons, a very conservative growth rate is used that cannot exceed that of a country's GDP growth. In this case, we have used the 5-year average of the 10-year government bond yield, which is 1.9%, to estimate future growth. In the same way as with the 10-year growth period, we discount future cash flows to today's value using a cost of equity of 6.9%. Now, the total sum of cash flows for the next 10 years plus discounted terminal value, which results in the total equity value, which in this case is $14 billion. The last step is to then divide the equity value by the number of shares outstanding compared to the current share price of $17.53. The company appears a good value at a 48% discount, giving an estimated price target of around $36.18. Again, this is a great discount seeing as the price is hovering around the $17 range. Now, as usual, take this with a grain of salt. These are just estimates, and there's many other ways to figure out a company's price target or intrinsic value. But let me know what you think below. The market's been getting beat down for I don't know how long at this point. But as usual, there's opportunities to be found, and Levi is one of those opportunities that I think I might take. The company is a long-term stock in my portfolio, and with it being around $17 right now, I can easily see in a couple years it getting to that fair value estimate of $36. But let me know what you think below about the stock. Please don't take this video as financial advice, and thank you for watching Morris Money.